Welcome to this explainer. Look, if you've ever stared at a budget and thought, oh great, another restrictive spreadsheet, or just saw it as some tedious annual chore, we really need to flip that script today. We are going to be looking at budgeting not as some annoying constraint, but as a completely strategic blueprint for corporate survival and success. How effectively a company handles this process can, quite literally, define whether they succeed or fail. So let's just dive right in and decode the actual mechanics of financial planning.
Here's our roadmap for today. We'll be covering the blueprint of business, the 6 objectives of budgeting, the anatomy of a budget, the human side of budgets, budgetary control and action, and finally, some next-level budgeting strategies.
Section 1. The blueprint of business, laying the foundation.
So, what is a budget, really? I know, it sounds like a painfully obvious question, right? We hear the term thrown around constantly, in boardrooms, on the news, and our personal lives. But to truly leverage a budget as a strategic tool, we kind of have to strip away all our preconceived notions.
Well, first off, let's clear up a few major misconceptions. A budget is not just some loose narrative plan, and it's definitely not just a tool for forecasting next year's price hikes. And, they aren't some mystical documents prepared exclusively by economists or high-level accountants sitting in a dark room. In reality, they're incredibly practical, everyday tools utilized by literally everyone across the globe, from single individuals all the way up to massive multinational corporations.
So here is the actual textbook definition. A budget is a quantitative and financial plan identifying the resources and commitments required to fulfill goals within a specific time frame. But honestly, it's easier to think of it like a GPS for your company's resources. You need to know exactly how much fuel you've got in the tank to hit your destination on time. It is all about setting aside definite resources to hit very definite targets within a very definite time frame.
All right, moving on to Section 2, 6 objectives of budgeting. This is the why behind the whole process.
A budget isn't just a static piece of paper. Its dynamic nature really comes down to these 6 core objectives. First up, planning. This forces management to actually anticipate problems before they blow up, instead of just making hasty, spur-of-the-moment decisions. Then we have coordination, getting all the different units synchronized and playing nice together. Third is communication, which basically acts like an executive order, passing top management's expectations down the chain. Fourth, motivation. Give people realistic targets and they'll actually strive to hit them. Fifth is control, setting spending limits and using variance reports so you can manage by exception. And finally, number 6, performance evaluation. You absolutely need a solid benchmark to measure how well your managers are actually doing. Together, these 6 steps completely transform a static document into a living, breathing management tool.
Section 3, Anatomy of a Budget. This is where we build the whole thing from the ground up.
Now, practically speaking, everything starts with one single, massive constraint. We call this the principal budget factor. Sometimes you'll hear it called the limiting or key budget factor. Basically, it's the overriding planning limitation on whatever the organization is doing at the time. I mean, think about it. You absolutely cannot plan to produce 100,000 units if your maximum sales demand is only 50,000, right? That bottleneck could be anything. Staff limitations, a scarcity of raw materials, limited funds, or even just not having enough warehouse space. Whatever that binding constraint is, you literally have to develop its budget first before you touch anything else.
And because of that constraint, budgets nest together in this really logical hierarchy. In practice, once the principal budget, which honestly is usually the sales budget, is set, all the other functional budgets just cascade right down from it. Production and material usage, those are calculated based purely on what you can actually sell. Once you nail down those functional budgets, they feed directly into the cash budget, which highlights your expected cash deficits or surpluses by lining up your receipts and payments. Finally, the whole shebang rolls into the master budget. That gives you your fully coordinated projected income statement and balance sheet. It's actually a beautifully logical flow when you put it all together.
Okay, Section 4, the human side of budgets. Because at the end of the day, team buy-in really matters.
We have to remember that budgeting is a deeply human, deeply behavioral process. If you want a positive climate, your employees, especially the ones who actually have to implement this stuff on the ground, need to participate in developing the budgets. When they're involved, morale and cohesion naturally go up. Companies really should set up a dedicated budget committee of senior management just to coordinate this. Plus, the system has to achieve what we call goal congruence. That's just a fancy way of saying the corporate goals need to actually harmonize with the individual employees' goals. And this is absolutely crucial. If a budget is used just as a penal mechanism or a blunt instrument for cost cutting, people are going to get defensive and it will backfire. It's just human nature. Which brings us to this really profound takeaway from the source material. Budgets must be strict but achievable. It is such a delicate balancing act. If you set entirely unrealistic budgets, you are actively destroying employee motivation. If a goal is literally impossible, people just stop trying, and the effectiveness of your entire strategic blueprint completely collapses. Individuals need the freedom and the authority to actually influence their own performance levels.
Section 5. Budgetary control in action. This is all about the feedback loop. Look, there is absolutely no point in spending all this time developing budgets if you aren't going to take control steps to actually achieve them. Budgetary control is the essential feedback loop of this entire system. It basically means taking the actual results you get from financial accounting, comparing them directly against the budget to find any variances, figuring out exactly why those variances happened, and then taking corrective actions. This is what makes budgeting a highly proactive rather than a passive endeavor. Now, when we're handling normal day-to-day fluctuations in activity, we generally look at two approaches. A fixed budget is developed for a very set level of activity, let's say exactly 50,000 units. But wait, what if the company actually ends up producing 55,000 units? Comparing your actual costs against a fixed budget that was based on a totally different volume is just unrealistic, and that's where the flexible budget comes to the rescue. By separating out your fixed costs from your variable costs, managers can adjust the budget to actually match the real level of production that was achieved. It provides a much more accurate and fair basis for control and performance evaluation.
All right, final stretch. Section 6, next level budgeting strategies. Time for some advanced cost control.
Traditionally, so many companies rely on incremental budgeting. They just take last year's budget, slap on a quick percentage for inflation or growth, and call it a day. Sure, it's simple, but it's also kind of lazy. It completely fails to diagnose cost behavior, and even worse, it literally institutionalizes past inefficiencies. On the flip side, we have zero-based budgeting, or ZBB. ZBB completely flips the script. It demands that management justify their existing activities exactly like they would for brand new proposals, meaning starting from a base of zero. It leans heavily on the concept of opportunity cost, forcing a really intense cost-benefit analysis on every single aspect of the budget to hunt down and eliminate those obsolete operations.
The ZBB process itself is fascinating. It requires managers to break their whole area down into specific program activities, which we call decision units. From there, they create decision packages. These detail alternative methods or maybe incremental levels of effort to actually get the task done. Then, those packages get passed up the management chain and are strictly ranked using cost-benefit indices. Finally, resources are allocated to the highest-ranking packages until, well, the money runs out. It essentially forces your managers to act like savvy investors trying to allocate scarce resources. Now, I'll be honest, it is a highly rigorous process, and it definitely generates its fair share of paperwork. But it is the one surefire way to guarantee an organization actually gets real value for its money, which leaves us with a final question to consider for your own operations. Are your established activities actually worth their cost? Or are you just blindly repeating the past because, well, that's what we did last year? Thanks for joining me on this explainer. Hopefully this helps you step back and build a better, far more strategic blueprint for the future.